Welcome back to class. We are in chapter 23, monetary policy, and within chapter 23, the optimal inflation rate. Let's first have a look at the inflation rates in OECD countries. And here we get the impression that in the most recent years, the inflation rate decreased to a large extent. So in the 1980s, the inflation rate was at the level of 10%. This was also due to the second oil price shock. And then the inflation rate decreased over time. So in the year 2000, the average inflation rate was at the level of 2.8%. You can also see here in the second row the number of countries with inflation rates below 5%. This was only 2 out of 24, and in the end, in the year 2010, it was the case that 27 out of 30 countries had an inflation rate below 5%. So most central banks, they aim for an inflation rate of 2%, so they have an inflation target of 2%. Why is it the case that central banks are so keen with respect to the inflation rate? Why is it the case that they want to bring inflation to the level of 2% to the target? What are the costs of inflation? To some extent, it is the case that we have the so-called shoe leather costs. These are the costs associated with more trips to the bank as people reduce their money balances. So in case that the inflation rate is high, also the nominal interest rate is high, and therefore the opportunity cost of holding money are very high. Hence, nobody will hold money in form of coins and notes. Everybody tries to have money in the banking sector because it is there where an interest rate can be earned, and hence money balances are very low in case that the inflation rate is high. And we call these kind of costs where people have to rush to the bank frequently shoe leather costs. It's also the case that we have tax distortions, like high inflation rates. They lead to higher capital gains and higher income taxes. So this is due to the fact that we have a progressive income tax, and in case that inflation is higher, people run into the higher tax areas. Money illusion. It is a case that people have problems to interpret inflation rates in the right way. People make systematic mistakes when they should assess nominal and real values, and they have problems to interpret nominal and real interest rates. In case that people have these kind of problems, of course, they cannot make right decisions, because for the decision in the end, what matters is the real interest rate or the expected real interest rate. And in case that people have problems to compute the real interest rate, then they make wrong decisions. Furthermore, also in case that inflation rate is high, then frequently inflation is also more variable. And also there, people will make wrong decisions because of the fact that when the inflation rate is high and variable, also the real interest rate will be variable. So the variability which is in the inflation rate will transmit into a variability of the real interest rate, and this will affect investment decisions. In case that there is a higher degree of uncertainty, then there will be a lower level of investment. And these kind of factors are all related to the costs of inflation. Let's also have a quick look at the benefits of inflation. First, we have to mention seigniorage. So we talked about that topic in the last chapter, in chapter 22. In the money creation process, either the government or the central bank can generate some revenues. It might be the case that the central bank is not independent, and then the government can force the central banker to print money. So the government will print bonds and will sell these bonds to the central bank, and the central bank is forced to buy these government bonds, and the government gets money in exchange. So then, of course, money would end up in the pockets of the government. In case that the central bank is independent, the central bank could also create money by buying corporate bonds. Or the central bank could also buy bonds like government bonds via the secondary market, not the primary market. And then it is also the case that the central bank can print money for nothing. The central bank is able to create money for nothing, but they earn in normal times a positive interest rate. In the end, the central bank will make a profit, and the profit will be reallocated to the government. Let's talk about the second benefit of inflation. Let's assume that a negative shock occurred, and due to this negative shock, the real wage has to decrease. There are two possibilities how a real wage can decrease. The first option is that the nominal wage decreases, so we have to cut nominal wages. Or the second option is via an inflation rate. In case that the inflation rate is positive, then goods prices will increase, and this can lower the real wage in case that the nominal wage is given. So there are these two options, and then the question is, what is easier to fulfill? Is it easier so that each and every company and each and every wage contract is organized with a lower nominal wage? Or is it easier for an economy to adjust real wages via the inflation rate? And here it seems to be the case that the empirical evidence points into the direction that it's much, much easier to adjust real wages via a higher inflation rate compared to lowering the nominal wages. Nobody will accept lower nominal wages. Furthermore, the third benefit of inflation is that in case that the inflation target is higher, then the probability of hitting the zero lower bound of the policy rate is lower. I would like to highlight this last benefit by coming up once more with a numerical example related to the Taylor rule. So we talked about this version of the Taylor rule, and we came up with the insight that in case that the inflation target is at the level of 2% and the economy is at an equilibrium. Equilibrium means the inflation gap is zero and the unemployment gap is zero. The central bank would establish a policy rate equal to 4%. So in case that this relationship here is zero and that relationship here is zero, like in normal times, the central bank would come up with a policy rate of 4%. So if you want to, the central bank has 4 units of ammunition to fight a negative demand shock. So there are 4 bullets in the weapon of the central bank. The central bank can shoot 4 times and lower the interest rate by 4 percentage points in case that a negative demand shock occurs. After the crisis, it was suggested to increase the inflation target pi star to the level of 4%. In case that the inflation target is at the level of 4%, the nominal interest rate would be at the level of 6%. So in case that the economy is at an equilibrium and the inflation gap is zero and the unemployment gap is zero, it is the case that the central bank would opt for a policy rate equal to 6%. And this would imply that there are 6 bullets in the weapon of the central bank. The central bank can shoot 6 times and lower the interest rate by 6% in case that a big demand shock hits the economy. So this argument is related to the benefits of inflation. It is the case that after the financial crisis 2008 and 2006, some economists argue that it would be a good idea to increase the target inflation rate to the level of 4%, so that the target nominal interest rate also increases to increase the number of bullets in the weapon of the central bank. Let's talk a little bit about unconventional monetary policy, which also took place after the financial crisis 2008-2009. One example of the unconventional monetary policy is quantitative easing, QE. Quantitative easing implies that central banks buy assets other than short-term government bonds. So for the Federal Reserve, it implies that in normal times, the Federal Reserve would buy short-term government bonds, which are called in the US T-bills. But in times of crisis, central banks are buying assets other than these short-term government bonds with the intention of decreasing the risk premium on those assets, and they also want to decrease the corresponding borrowing rates in order to stimulate the economic activity. So in case that central banks perform quantitative easing, they also buy long-term government bonds, they buy corporate bonds, or some central banks even started to buy equity. For example, the Swiss central bank bought equity. They also invested in stocks. In the textbook, you can read the following sentence. Central banks finance their purchases through money creation, leading to a large increase in money supply. You can read that on page number 494. This sentence is right. It is not the case that money supply increased tremendously. It is the case that monetary base increased tremendously. So not the M variable increased, but the H variable increased. The money supply grows, the growth of M3 in the euro area was relatively low. Let's have a look at the money supply growth rate in the euro area. You can see that in the next slide. The time period is from 99 until 2011, so the introduction of the euro in 99. The target rate for the money growth rate is equal to 4.5%. Please introduce here one line at the level of 4.5%. You can see that before the crisis, the real development was higher than the target rate. But after the crisis, it is the case that, for example, in 2009, 2010, the growth rate of money supply is at the level of 0. So money supply does not increase. And also, it is not the case that this kind of central bank action, like quantitative easing, leads to a large increase in money supply. This is not the case. Despite quantitative easing, it is the case that the realized growth rate of M3 is below target, even in 2011. So this sentence here is definitely not right. Although the increase in money supply or in the monetary base has no effect on the policy rate, it is the case that the purchase of these other assets, like long-term government bonds, corporate bonds, equities, they lead to lower borrowing rates. This is the main idea of quantitative easing. So the final idea is that the central bank wants to decrease the risk premium. The central bank wants to lower the borrowing rates for which companies get access to the money market or the bond market. The central bank wants to lower the borrowing rates for companies. When you look at the textbook, you once more can see the increase of the monetary base of the US. And in the time period from 2005 to 2008, you can only see a small increase in the monetary base. So what is really exploding after the financial crisis hit the American economy is the monetary base. It is not money supply. Once more, I don't know why this textbook, which is called like a European text, only has empirical evidence for the US. So I looked for some graphs which can be used to highlight the international evidence with respect to quantitative easing. I found here one graph which is interesting because it compares a ratio which is called the central bank balance sheet divided by the GDP. So of course, like when we compare like small countries, like for example Switzerland, with large countries like the Euro area or the USA, it is important that we normalize the central bank balance sheet by some figures like, for example, the GDP of the country. Only then we are able to perform this international comparison. And you can clearly see that the Federal Reserve did quantitative easing after the financial crisis. You can see here the green line, which represents the line for the Federal Reserve, and the Federal Reserve performed quantitative easing. So did also the Bank of England, the blue line. But it's the case that the European Central Bank, like this orange line here, also performed quantitative easing and did so especially in the year 2011 and 2012. This is not the case with respect to the US, because it is here when the bond spreads of Italy, Greece, Spain, Portugal increased so much so that in the mid of 2012, Draghi had to give his famous talk, whatever it takes. So quantitative easing of the ECB took place at a later point in time compared to the Federal Reserve, especially here 2011, 2012, quantitative easing of the ECB. But this monetary policy action is not the most dramatic development we have seen. It's also the case here that Japan performed quantitative easing, and they started to come up with a new growth rate of the central bank balance sheet in 2012 and also in 2013. We call these kind of policies like Abenomics, because the Japanese government got a new prime minister, Abe, and he changed or influenced the central bank to change the growth path of the central bank balance sheet. So for Japan also, it is important that after 2013, the degree to which quantitative easing was performed changes dramatically. With respect to Switzerland, we should keep in mind that at some points in time, Switzerland tried to fix the exchange rate, the Swiss franc to the euro. So they had a fixed exchange rate system in place at some point in time, and this also causes some fluctuations in this ratio central bank balance sheet over GDP. So you can see here this line which represents the Swiss central bank, that there is a very high volatility, ups and downs, especially in very short time periods. We can see peaks, and these peaks are time periods where the Swiss central bank intervenes at the foreign exchange market. They are buying foreign assets, so the Swiss central banker is printing Swiss francs, and then the central banker has to buy foreign assets, and when the foreign assets are put into the bank balance sheets, we can see here this huge spikes, this huge increases. They stem from central bank intervention in the foreign exchange market. So when it comes to international evidence, it is the case that the increase in the monetary base of the US is really not so dramatic. We have seen other examples than the US, which are even more dramatic. I think that this is a very nice comparison here because we can compare so many different countries, and we can also come up with different reasons why quantitative easing was performed. In the euro area, we can directly see where Draghi was giving his famous talk, whatever it takes. For Japan, we can see when Abe took over the position as a prime minister. And for Switzerland, we can see the speculative attacks at the foreign exchange market. So a very nice graph where we can talk a lot about different arrangements. In the last part of this chapter, I would like to talk about monetary policy and financial stability. And here I would like to talk about two aspects. And one aspect is the so-called lender of the last resort function of central banks. In case that there is a big crisis, in the end, it is only the central bank which can create liquidity without any limit. The central bank can create as much liquidity as it wants, and thereby the central bank can support banks, the central bank can support governments or even other institutions in case that these institutions fall short in liquidity. The central bank is the only institution which can create liquidity in an unlimited amount. The big question is whether a central bank should have this role and whether the central bank should use this role. And at some point in time, with respect to the crisis in Europe, it became evident that we have not talked and we have not thought about the role of the ECB with respect to the lender of the last resort. Has the ECB the right to act in this way, yes or no? In the end, it was Draghi who said, yes, I think that the ECB has this role, and Draghi took over this kind of role. And also some European courts, they have confirmed that the ECB has this lender of the last resort function, but this was not completely clear. The big question is whether a central bank should consider to play this role and provide liquidity to institutions which are not regulated by the central bank. With respect to the ECB, it was the case that the ECB in the end supported banks, but also took over a major role in banking supervision. With respect to the crisis, the consensus is that it's too risky for a central bank to wait before a price bubble bursts. So the central bank or some institutions like banking supervision organizations should try to avoid the building up of a bubble. It is the case that the institutions have several rules and several instruments to deal with the build-up of the bubble. So, for example, one important institution is banking supervision. And this is important because banks are giving credits to the real estate sector, and this price bubble in the real estate sector can only build up when also the commercial banking sector is playing this kind of role of financing real estate projects. So it's very important to have a look at the banking sector and how the banking sector is regulated. And there we have two different concepts. So a microprudential rule or a macroprudential rule, or like a microprudential view on the economy or a macroprudential view on the economy. Microprudential means that the banking supervision focuses on a single bank. And the idea behind this rule is when all single banks are stable, then also the whole banking system is stable. When it comes to the macroprudential rule, it is the case that the banking supervision institution would also focus on the overall banking sector, or the financial supervisory institution would even look at other financial institutions, would have a look not only at the banking sector, but the whole financial sector. So, for example, would also include insurance companies. There, the idea is that it's not sufficient to just look at the single bank, but we also have to look at the whole banking sector and how the banks are connected. And this is an important rule which the ECB took over, that they want to look more on the overall banking sector within the European Union. And they believe that it's not important, the ECB believes that it's not sufficient to supervise the banking sector on a national level, but the banking sector has to be supervised on an EU level. When we think about influencing the financial sector or influencing the real estate market, it is a case that we have to keep in mind that the policy rate, like the interest rate, is only one instrument. There are a lot of other instruments which the central bank or the banking supervision can use. For example, one instrument is the loan to value ratio. It might be the case that a banking supervision institution comes up with a ceiling on the size of a loan borrowers can take relative to the value of the house they buy. The idea is when we reduce the maximum loan to value ratio, then it is likely to decrease the demand for housing, and thereby we can slow down the housing price increase. There is some empirical evidence in the textbook. For example, it is the case that in Germany, you can only borrow 80% of the capital needed to buy a house. This is also the case in Japan, Switzerland, Italy, or Denmark. But this value is even lower, for example, in Korea, and it's even higher in the Netherlands, where this LTV ratio is even larger than 100%. This value of 125% implies you can buy a house, you can also renovate the house, and you can finance a new kitchen. With respect to the empirical evidence, it seems to be the case that there is a positive relationship. So the higher the maximum LTV ratio, the higher the nominal house price increases from 2000 to 2007. So there is indeed a positive relationship, and therefore it is a case when the regulator changes this maximum LTV ratio allowed, they can also influence the house price market. They can influence the real estate market. This is the end of this chapter. Thank you very much. Have a nice day. Bye-bye.